Hey everyone, welcome back to the channel. If you're a business owner dealing with e-invoicing in Malaysia, today's topic is a must-know. We're talking about self-billed e-invoices, what it means, who needs to generate it, when it's due, and under what conditions it's allowed. Let's get started. First, what exactly is a self-billed e-invoice? A self-billed e-invoice is an invoice that is generated by the customer or buyer of goods or services on behalf of the seller. Yes, you heard that right. Instead of the seller issuing the invoice, the buyer takes on the responsibility to issue invoice to seller. We called it as self-billed e-invoice. This arrangement typically applies when the seller is unable or not equipped to issue an e-invoice on their own. However, it's important to note that buyers cannot issue self-billed e-invoices freely. They are only allowed under specific conditions set by the LHDN to ensure proper compliance. For the buyer, the self-billed e-invoice acts as a valid proof of expense for tax reporting. For the seller, it serves as the official record of income for that transaction. When exactly can you issue a self-billed e-invoice in Malaysia? Not every buyer can simply issue a self-billed e-invoice. It must follow specific conditions approved by LHDN. So, let's go through the exact scenarios where self-billing is permitted. If a company makes payments to agents, dealers, or distributors, the company is required to issue a self-billed e-invoice to reflect the payment or expense. When you purchase goods from foreign suppliers or importation of goods from overseas, who are not registered under Malaysia's e-invoicing system, you, as the Malaysian buyer, must issue a self-billed e-invoice for the transaction. When you use a foreign supplier's services, also known as importation of services such as Google, Facebook, Dropbox, who are not registered under Malaysia's e-invoicing system, you, as the Malaysian buyer, must issue a self-billed e-invoice for the transaction. If a company distributes profits, such as dividend payments, a self-billed e-invoice must be issued to record the transaction, even though it's not a typical sale. However, dividends declared by public listed companies or single-tier dividends by private limited companies, Sendiri and Berhad, do not require a self-billed e-invoice. Commerce platforms such as Lazada and Shopee are authorized to generate self-billed e-invoices on behalf of their merchants for transactions conducted on their platforms. Merchants are not required to take any action in this process. Companies in the gambling and betting industry, such as Magnum or Toto, must issue self-billed e-invoices for payouts to winners, ensuring winnings are properly recorded for tax and reporting purposes. If you make payments such as rental or referral fee or commissions to individuals who are not conducting a business and are not your employees, you're required to issue a self-billed e-invoice for those payments. Interest payments. If you're making an interest payment to such individuals or entities, you, as the payer, are required to generate a self-billed e-invoice for that transaction. But not all interest payments require self-billed e-invoices. Let's go through a few key exceptions where self-billing is not necessary. Loan interest payments charged by a bank, the bank will issue the e-invoice to you instead. Interest paid by an employee to an employer. Interest payments made by foreign payers to Malaysian taxpayers. Interest payments to a related company, late payment interest, or charges imposed on customers. These scenarios are excluded from the self-billed e-invoice requirement. However, take note. In these exception cases, the supplier or recipient of the interest income is the one responsible for issuing the e-invoice. In the case of insurance claims and compensations, the insurance company will issue the self-billed e-invoice to the beneficiary. As the recipient, you don't need to do anything. When making payments to investors for capital reduction, share redemption, share buyback, return of capital, or liquidation proceeds, companies are required to issue a self-billed e-invoice to reflect the payment. So, when exactly do you need to issue a self-billed e-invoice? In general, you may follow your usual billing cycle, whether it's based on as and when incurred, bi-weekly, monthly, or any other consistent frequency. The key is that you don't need to issue a self-billed e-invoice for every single transaction immediately, as long as your billing cycle is consistent, properly documented, and aligns with your established practice. However, when it comes to use of foreign supplier services, the rules are stricter. A self-billed e-invoice must be created at the point the service is rendered or when payment is made, whichever comes first. And once that happens, you must issue the e-invoice no later than the end of the following month. If you're importing physical goods, the timeline is different. You'll need to issue the self-billed e-invoice by the end of the second month, following the month in which the Royal Malaysian Customs Department, RMCD, clears the goods. Contact us now if you are looking for e-invoice consultation or e-invoice implementation services. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more updates on taxes and e-invoicing. Thank you for watching.